Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my latest Mind Over Markets video interview. With me today is my longtime colleague, Jim Pearce. Jim Pearce is Chief Investment Strategist of our flagship publication, Personal Finance. He's also in charge of our premium service, Mayhem Trader. We'll get to Jim's Mayhem trading methodologies in a minute. Jim, thanks for being here today.
My pleasure, John. Good to see you.
Yeah, good to see you. All right, let's get right to it. The stock market has been rallying lately, but what risks do you see over the near term that the investment herd is underestimating?
Although inflation is slowing down, the full impact of accommodative monetary policy during the coronavirus pandemic is far from over. The amount of money in the United States, as measured by M2, is 25% greater than it was in February 2020, just before COVID-19 shut down the economy. That's what prompted inflation to skyrocket, rapidly increasing prices for food, housing, and transportation. Thus far, we haven't seen much of a slowdown in consumer spending despite higher prices. Wall Street seems to believe that will remain the case regardless of what the Fed does next. But if consumers stop spending, then a recession will be unavoidable.
Jim, you started your career as a stockbroker and you have an amply stocked toolkit of trading methodologies. Explain for us how you leverage market mayhem for profit.
Thanks. Yeah. So my system identifies stocks that have become overvalued based on several fundamental and technical metrics. That does not necessarily mean that they are certain to crash, but it does mean that they are more vulnerable to a sudden change in direction if there is any change to the narrative that is driving their current momentum. The same herd mentality that drove the share prices up can do the exact same thing in reverse. By the way, that's also true for stocks that have become oversold. That's why I will sometimes recommend call options on companies that I believe could rally strongly once Wall Street realizes it made a mistake.
You know, history shows that once the Federal Reserve ceases its tightening cycle, stocks embark on an upward trajectory. We appear to be reaching the end of the current cycle, but until we get definitive clarity on monetary policy, the market will be volatile and uncertain, won't it?
Absolutely. It's only in hindsight that we know when a bear market is finally over. Before that happens, there can be several false starts that result in rapid changes in direction based on conflicting economic data. That's why Fed Chair Jerome Powell has repeatedly stated that he will keep raising interest rates for as long as it takes to get inflation under control. At the same time, he wants to give himself leeway to not raise rates if the economy continues to cool off. That's why he cannot be definitive about what he's going to do, since that is conditional on future data that we haven't seen yet.
Well, isn't that sort of mayhem your investment sweet spot?
Yeah, that's half the equation that creates a market mayhem sweet spot. The other half is identifying sectors of the economy and stocks within those sectors that appear to be priced for perfection and therefore vulnerable to a quick sell-off if their performance disappoints Wall Street. They aren't hard to find since their relative valuation can be compared to their historical metrics and to their peers in the current market environment. Sooner or later, reversion to the mean will bring them back into parity. My objective is to identify those sectors and stocks just before that happens.
All right, Jim, which sectors of the market look most promising to you right now?
Well, for my put option trades, and remember, put options go up in value when the price of the underlying security goes down. So I'm looking for sectors that are overvalued and likely to decline in price in the near term. Right now, the tech sector appears to be overbought from both a fundamental and technical perspective. So far this year, the information technology sector of the S&P 500 index is up more than 40% compared to less than a 20% gain in the index. In other words, it's up more than twice as much. Also, consumer discretionary stocks have gained nearly 40%, even though they would be most vulnerable to a recession. Now, at the other end of the spectrum is the energy sector, which is down about 6% over the same span. That makes it attractive for call option trades. Now, remember, call options go up in value when the price of the underlying security goes up, since it's only a matter of time until something happens to drive oil prices higher. Once the war in Ukraine is over, price limits on Russian oil will most likely be removed, allowing global energy prices to revert to equilibrium. By the way, healthcare stocks also look cheap to me, which are also down this year despite inelastic demand for most of their products.
You know, the rally year to date in the S&P 500 and the NASDAQ has been largely driven by enthusiasm over artificial intelligence. AI is the big buzzword so far this year. Tech stocks took a real beating in 2022. They just got really clobbered last year. But right now they're trading at rather lofty valuations again. Do you think tech stocks are ripe for a pullback?
Yes, I do. In truth, the big run up in mega cap tech stocks is really nothing more than a risk off approach to the stock market. Those companies are sitting on a lot of cash and could withstand a recession better than most other businesses. However, they won't be able to grow profits as fast as Wall Street expects if the global economy contracts. For example, Apple relies almost entirely on consumer spending for its revenue. If time gets tough, a lot of people may decide to hang onto their old iPhone a while longer rather than upgrade to the latest model. Apple is the most valuable publicly traded company in the world. So if it hits the skids, then you can expect all the major stock market indexes to follow suit.
Let's discuss some technical indicators right now. The New York Stock Exchange Advanced Decline Line, the NIAD, hovers above its 50 and 200-day moving averages. That indicates increasing market breadth. The NIAD has been rising. Small caps and financials have been in the vanguard of this rally too. It's not just the mega cap tech stocks. So aren't these signs of market breadth reassuring to you, Jim?
They are reassuring, but keep in mind, small caps and financials have participated in the rally, but to a much lesser degree than tech stocks. Small cap stocks, as measured by the Russell 2000 index, gained 7.2% over the first half of this year, while large caps, as measured by the S&P 500 index, were up 15.9%, while the tech-heavy NASDAQ Composite Index shot up 31.7%. If Wall Street really believed that inflation was tamed and a recession was unlikely, then small cap stocks would be up a lot more than that. As for the financial sector, it has barely eked out a positive return so far this year, which means Wall Street is not confident that the economy will be strong over the second half of this year.
Those are very good points. All right, so the stock market has been driven to a large degree by the AI frenzy, but aren't there better plays, in your view, on the artificial intelligence boom than just the obvious choices, the mega cap story stocks that get covered to death on CNBC? Have you unearthed any under the radar picks and shovels plays on AI that are better bets for investors?
I have, because if you're looking for call option plays, then I'd avoid the mega cap names. The premiums are just too high. There isn't enough upside potential. The downside risk is enormous. In addition to being overvalued, the time premiums for those call options are inflated. So you need a big upside move from where they are now to generate a gain sufficient to justify taking that risk. That being the case, I think the safer bet is to look for companies in adjacent sectors that will benefit perhaps more indirectly from the AI revolution, but just as much. The fact of the matter is that the huge tech companies that everybody knows are heavily reliant on their vendors that operate in anonymity. You don't see their names on the cool tech gadgets that you buy, but they benefit just as much from the sale. In many cases, those pick and shovel plays outperform mega cap stocks since they can grow their profitability at a much faster rate.
Excellent. Jim, thanks so much for your time.
You're welcome, John, and thank you.
Yeah, absolutely. Jim Pearce just discussed his Mayhem trading methodologies. Want to learn more about his premium service, Mayhem Trader? Click the URL at the bottom of the article that accompanies this video on the Investing Daily website. And if you have any comments or questions, please don't hesitate to send me an email at mailbag@investingdaily.com. Thanks so much for watching.